Securities offered through Kestra Investment Services, LLC. Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here are Josh Gilbert and Jeff Zufall.
Hello and welcome to Keep What's Yours with Jeff Zufall. I am Josh Gilbert, sitting here with Jeff Zufall. He is the senior tax strategist and wealth advisor with Capital Advisory Group. Hello, Jeff.
Good afternoon. How you doing?
Good. And
Good.
I wanted to just jump in here because I said it before, but I want to say it again because it really is important to make this distinction. Senior tax strategist, that's on your title.
Yes.
Wealth advisor, that's on your title.
Yes.
Over at Capital Advisory Group. And, that's a long nameplate.
It is.
On your desk, The buck stops here and then this giant nameplate with all your titles on it. But it's important to make that distinction because you are both a tax strategist and a wealth advisor. A lot of people out there, they have a tax guy.
Exactly.
And full disclosure, you are my tax guy.
Yeah.
And a lot of people have a money person, and full disclosure, you are my money person.
Yes.
But a lot of times those people are two different people.
Yes. And the confusion comes into play when, say, the broker says one of the things that's going on right now that we're working with clients on is tax lot trading. So what that basically means is you go to your brokerage account. Now, this only works for taxable brokerage accounts, no IRAs, and you reset the deck. You sell the losers, basically. So if you needed to create capital, you would do that, and you would net out no tax, or that would be the ultimate end game. But let's say that you just have a bunch of losers sitting in your portfolio, and you've been waiting all year long, like, hey, I'm going to wait till it comes back, and so on. And unless you've purchased that with an intention, an exact dollar amount, like, hey, I bought this stock for $10 a share. If it gets to 11, I sell it, or if the fundamentals do this, I will sell it. But the tax side of it says, look at your portfolio, sell the losers, create a capital loss. Any capital loss that you create offsets a capital gain either this year or there's a carry forward in the next year until you use it up. And if you don't have a capital gain, you get $3,000 against your income to help decrease your taxes. So we see brokers saying, hey, we're going to do this, tell your accountant. The accountant goes, huh? And literally doesn't get what the broker's talking about.
Right.
So that's where the big disconnect comes into play.
Because
we do it all.
Everything you do, and we mention this on this show all the time. This is basically the whole function of this show. Everything you do has a tax implication to it, whether you're buying Christmas presents,
exactly,
holiday presents, or whether you're buying groceries at the store, whether you're paying, incredible inflation. There's taxes involved there, which that's where most of you find that.
That's a hidden tax is what that is.
Everything you do has a tax associated with it. And what we try to say on this show, try to minimize that tax risk on everything that you do. So me personally, I'll mention it again. I mention it every week. We have to pay my son's daycare.
Yes.
Just there's no ifs,
you're not getting out of it.
Unless somebody, listeners, I'll put it out there. Do you want to come and watch my son for free? I'll probably get some of the weirdest
There'll be a bunch of people going, hey, cool.
Honey, the weirdos are here to interview for nanny positions for free. I have to pay it unless somebody wants to watch. And my mom, his grandma, she's just, I'm too old for this.
Exactly. Hey, that's my wife's saying the same thing now. She's like, wait.
Is that line from Lethal Weapon, Danny Glover? I'm getting too old for this. So, I have to pay daycare. Well, Jeff comes to me and says, well, did you know about an FSA, a flex spending account? You pay your daycare, but you have stuff taken out of your paycheck every 2 weeks. And set aside, it's tax.
It's pre-tax, basically. It's
pre-tax.
So you're not paying tax. So if you would have let the IRS tax you on that income, you would have to pay federal and state income tax on it. You'd have a net amount, probably every bit of anywhere between 15 to 25% less. And then you'd use that to pay the daycare, whereas this is pre-tax. So you're saving $1,200, $1,300 straight across the board that you don't have to pay tax on that you're using for daycare. Anyway.
And it's crazy because I've got to pay that regardless.
It doesn't matter. They want their money. Exactly.
So when I do this, I'm using $1,200 essentially of the government's money.
That they give you a free ride, if you want to call it that.
Yeah. And I never would have known about this had I not talked to Jeff. And that's the thing with your tax guy also being your wealth guy. I want to make some moves. Well, then, the wealth manager guy, maybe he's not clued into all the taxes that are out there or the benefits.
I'd say the bulk of them know it generically, but they don't know how at the end of the day, how it affects your tax return. I mean, honestly. Some of them some reps will ask for the tax return. But again, at the end of the day, they're not preparing the return. They're not doing the deep dive calculations on the tax return. It's generic. Oh, hey, your capital gains rate might be 15%. Well, yeah, it could be. But let's say you have a huge bonus and a huge capital gain one year. You may go over the threshold, and then you're paying 20. And they don't the reps don't mean any harm by it. It's just they don't know the real technicalities of the tax return.
And maybe my money guy makes some moves for me, but he doesn't know that I sold a house or sold some property, or he doesn't know that I got that bonus at the end of the year, and he doesn't know that we're doing this, that, and the other, saving for college and all that stuff. All of that adds up.
Exactly.
That's me on paper at tax time, and if he only sees what he's pulling out of my IRA.
Or maybe there's different accounts. You have multiple accounts out there with different brokers. Nobody's communicating to one another. One creates a capital gain. Another one creates a capital gain. The one instance last year, which to the client's side, yes, he should have paid a little bit more attention, but he didn't. The reps, the account was down. They were losing a little bit of money. They went in, they reset the deck, and they generated dividend income for the gentleman. And at the end of the year, he owed $18,000 in federal tax, and he was mad.
Yeah.
So I'm the poor person that has to go, hey, by the way, you owe this money, and then they're like, what? So
they get mad at you.
And they get mad at us, like, hey, you messed up the return. I'm like, no.
Go talk to your other guy.
So at the end of the day, I was able to say, hey, you made about $95,000 more in dividend income than you did in the past, and that was your culprit. And then he got kind of mad at me and mad at the rep, even though the rep did his job, created the income. I know they had that conversation. He just didn't realize how big of that dividend would be. And then the companies raised their dividends last year too. So it was kind of funny. I mean, at the end of the day, he was good with it. But to explain,
he made money.
He made money. So yes, he made 4 times what he did the year before. And so this is one of the issues today that we're going to see on the 2023 tax returns coming here shortly to a neighborhood near you, like in a month and a half, is the good side of the Fed raising interest rates is now you can make in a money market shy of 5%, no risk, liquid money, just sit there at 5%. You're still losing because of inflation, but still it's that mental factor of you're making money. But if you take that, it's 5 times higher than what it was 18 months ago. So people are going to see interest income showing up, and the bad effect is now you owe more tax.
Yeah, and that's one of those things that if you have your wealth advisor also being your tax guy, which is what Jeff is, that's the benefit, he can make some plays for you to either be beneficial or he can stop you from doing something.
And say, Roth conversions. We see a lot of people are like, hey, everybody talks about it. And some people it works for, and some people it is a complete disaster at the end of the day. I mean, because the way that it's portrayed is, hey, convert this $50,000 in your Roth and you'll never pay tax ever again. But they don't take the tax from the Roth. You pay it from someplace else, so it looks great on paper. In reality is the calculation is if you convert 50 in a Roth, how long does it take you to make back your tax money to where you're break even? And in some cases, it could take an eternity because of the tax bracket the individuals are in.
Yeah.
And in some cases, it takes 2-3 years, and you're way ahead of the game.
Tax bracket bingo.
Yes, and it's the math that we put together. A lot of people don't realize, too, on IRMA, which is your Medicare premiums. We've had that discussion with Jan Berhaney in the past. We've talked about it. If your income skyrockets, I have 2 sitting on my desk currently where we have to petition to see if we can get it reduced. Otherwise, they go from $171 a month to $559, I believe, is the 23 number, or well, soon to be 24 number. So those are huge issues that pop into play that people get blindsided with that they don't even realize that are out there.
Yeah, and that ultimately, at the end of the day, this show is called Keep What's Yours. And whether it's $1,000 here or $500 there, the last thing you want to do is look down on paper and say, Jeff, where's all this money going?
Exactly.
Say, that could have been yours. You
Put
could have
pocket.
kept what's yours.
Exactly.
Rather than going out to the federal government. And I say this all the time as well. The tax code is what it is. It's kind of built for corporations and rich people.
It is to a degree, but again, there's a lot of stuff out there that we can take advantage of.
The little guy,
and
like me.
Exactly. It's little. It's
when
little
do I get
things.
my share? And it's like, well, there's stuff in there.
There is.
But I wouldn't know about it.
Exactly. It might save you $100 here, might save you $1,000 there, but it's a matter of putting them all into play for a tax return.
But at the end of the day, math being what it is, $1,000 plus $1 plus $100 is $1,100.
Exactly.
That could help me for 6 hours at Disney.
That's right. That's if you walk slow.
Yeah. Only 6 hours, though. Before we get to our topic of the day, year-end stuff, because the year-end is coming up, and, Jeff, you just mentioned Roth conversions. Now's the time to start.
Now's the time to start to put those numbers together. Seriously.
Do the math, and we'll get into all that. That's our topic of the day, because the year-end is coming up. We don't have a lot of time left. But the perfect thing is, now you know basically what your year looks like.
You know what your year is. You can literally pretty close within a few dollars ballpark the tax brackets, where you're going to fall.
Trying to do the math and predicting what your year end is going to look like in August is a lot harder than
way harder. And it's a gigantic guess is what it is.
Exactly. But before we go to commercial break and before we hit what's in the news, you touched on something, and I need this is me personally talking, right? Okay, let's shut the mics off. All right, Jeff, here's what's going on. I had a capital loss this year, and after talking to you, a stock was just down, and I was like, look, I told my wife, I said, look, this thing ain't going anywhere.
Yeah.
Let's just sell it, and if you want to buy it back in 31 days.
Exactly.
Because that's the game. You can't, you got to sell it and then wait
31 days.
31 days.
To buy the same or a similar stock. And again, you got to be careful in ETFs because one ETF may mimic another, and by IRS guidelines, they may say, hey, that's a similar stock.
Right.
But
you got to wait or else you don't get the capital loss. I was like, it's not going anywhere. It's already down. Let's sell it. And if you want to buy it back, then we could buy it back later. So we sold it, I got a capital loss sitting out there. Here's my question, and I'm sure that this pertains to a lot of listeners as well. You already touched on it. I need some clarification. A capital loss, I'm sitting on one right now.
Mm-hmm.
Does it only offset capital gains? Because I don't have any capital gains this year.
So if you have no capital gains, of the loss, you will get $3,000 that goes against your ordinary income or your W-2 income. And then that is a loss carry forward that sits on the books until you use it up. So if you never had a capital gain ever again, you would get $3,000 a year every year until you used it up. But it only stays with you and your wife. You can't pass it to anybody.
And I'll tell you this, we did not get a capital loss of $3,000.
Yeah.
So, we're dealing in pennies over here, but every bit counts.
Exactly. Now, remember, though, what's hidden in there that you don't see, and it's coming this week between now and Christmas, seriously, is capital gain distributions from mutual funds. So 23 was started off great, dropped a little bit, came back to life. So you're going to see this weird year. So you may go, hey, I only made like a 4 or 5% rate of return on this mutual fund. It's going to dump a huge capital gain on you here shortly in the next couple of days, and you don't know what it is. So it's up to the fund family and the individual funds themselves to do a distribution by the number of shares proportionally owned by people. So if you're the majority shareholder of that mutual fund, you're going to get a huge capital gain distribution. And what that is the buys and sells of the mutual fund that you own all year long. And if it's positive, they don't want to pay the tax. So they distribute it out to you proportionately.
Yeah.
So you could get terrible year, you could get $5,000 in capital gains dropped on you.
Yep.
So that capital loss is always kind of like an insurance policy in your back pocket, and it'll help at least offset a couple $1,000s of the gain.
And again, this is why you want your tax strategist, your tax person, to also be your wealth advisor, because that Jeff knows.
Exactly.
Jeff says, well, we can use the tax code to our advantage and just plug it in to what you're doing on the wealth side of it. So it's very beneficial. I had my sister-in-law in town from San Diego over the weekend, and she was talking, and she had mentioned, well, our tax guy is also our wealth planner.
Exactly.
And I'm like, oh, don't you love it?
Exactly.
And she literally said to me, she goes, it didn't always used to be that way, and it's just when we made the switch, it's all the difference in the world.
It is.
So having Jeff do that for you, he does it for me. He doesn't necessarily do it for my sister-in-law out in San Diego, but she's taking advantage of the same setup.
But she can call me. We're licensed in California.
There you go. Having your tax strategist, your tax guy also be your money guy or gal is incredibly beneficial, and that's what Jeff does. 636-394-5524, CapitalAdvisoryGrp.com. That is where Jeff works. That phone number will work. You give that a call, get an appointment on the books, go and see Jeff and say, hey, how can I take advantage of having my tax guy be my wealth planner? And he can go through it with you. It works out for me, works out for my sister-in-law out in California. It can work out for you as well. Let's go to commercial break, and when we come back, a couple of stories in the news, plus year-end planning. And we'll probably do a couple of shows where we touch on the year-end stuff.
Yeah.
Because you want to take advantage of it before Jan 1. And make sure that if you need to sock more into your 401k, do it now. If you need to do a Roth conversion, do it now. This is when you know when the math will actually play out in your favor, so now's the time to do it. We'll come back. It's Keep What's Yours with Jeff Zufall on the Big 550 KTRS.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, back to Keep What's Yours, and we're pretty far through the show. I haven't hit our topic of the day, but I think the year-end stuff, we're going to cover that ad nauseum over the next couple of weeks, just because we want to remind everybody now's the time of the year to really do some deep dives into your financials and see where you can take advantage of the tax code, where can you do your Roths, can you sell, what can you take a capital loss on. The math is going to work now because you probably know for the rest of the year what you're going to make.
What you're going to, maybe a small percentage of people have a giant bonus that sneaks in that they didn't expect, But,
you're waiting on that big bonus so you can pay for that pool, and then you get Jelly of the Month Club.
Exactly. I watched that the other night.
Christmas vacation. Yes. So maybe there is a bonus out there that you're not aware of, but maybe you already know what it's going to be, because it's always this every year. Yeah. So you can do the math now and just say, hey, Jeff, I've actually got $20,000, $25,000 wiggle room before I hit a new tax bracket.
Exactly.
What can I do as far as doing the Roth conversions? We'll get into that, but I want to hit what the news is up to these days, because we have been talking about the ERTC, the Employee Retention Tax Credit.
Yes.
That is something that we have hit on this show, and, it's post-COVID. It's kind of one of these things. Did you keep employees throughout the pandemic rather than letting them go and drift
laying
onto,
them off?
Drift onto the unemployment rolls?
So anybody, business owner, this really applies to you. If you haven't applied, it's still available out there. You just got to be really careful. So this applies to anybody else that applies. If you had an employee March of 20 to September of 21, if you had employees on the roster and you were paying what's called the Fed FICA, which is the employer's side. Remember how it's 15.3. If you paid your half, you get a credit back for having people on payroll, basically. And so when this opened, unfortunately, like a standard government program, there's fraud galore. People that never had a company, that never had an employee showing up, there's what's called ERTC mills. So we had people that would come to us and say, here's all my numbers. Can I qualify for any money? And the calculation would be done. It comes back and says, no, you can't, because you had to have a decline in revenue and all these weird factors that had to all play together. They would then leave us, go to a ERTC mill and they'd go, oh, yeah, we can get you $100,000. The problem is yes, some people got that paid to them. The IRS is going to come ask for it back. And what they're doing is they shut the program down maybe 2 months ago because they realized the fraud was rampant.
I mean, they were getting 20,000, rejections.
Exactly.
Just coming in. So it's like even that is probably overwhelming for a bureaucracy.
God, I think the inflow got overwhelming for them. So then they were just processing whatever showed up in the stack.
Only come here if you qualify.
Yeah.
And then you got 20,000 people mobbing that don't even qualify. And it's like it takes time to send them rejection letters.
And there's a couple of, I don't want to say their names on the air, but their name brand, you've seen them on TV.
Well, the guy from, I won't say the show, but, there's two people, well-known household names that you've seen the commercials on TV.
Those were ERTC mills. They've been shut down by the IRS.
So you won't see those commercials anymore?
Won't see them anymore. And they act like, oh, we never did that.
Well, here's my thing. You are a tax professional. And you specialize in small business, actually. Mm-hmm. So if I am a small business and I want to take advantage of this ERTC, a government program that's giving me money back and thanking me for keeping people employed during the pandemic, shouldn't I go to a professional?
Exactly.
And then all of a sudden, I heard things on the radio, people on the radio. Coming from you makes sense. Coming from the radio guy saying, "Oh, call my guy," national radio programs,
and that's how they were doing it. And they got a
TV
huge
show, and I'm like, "Who are these people?"
Well, and the problem is the fee to do the paperwork for the ERTC sometimes ramped up as high as 18%. So if you got $100,000 credit coming back to you, whoever did the paperwork got $18,000 for doing it. Mm-hmm. So you go, ooh, that's why there was rampant fraud. So IRS shut the program down, said we're not accepting any new applications from third-party providers. So,
and didn't you tell me that some of these companies would charge and say, "Oh, you're going to get $100,000 back. Charge you $18,000."
Yeah,
and then the government comes back and says,
"Oops, sorry,
you don't make the cut. You don't qualify for that."
Or we're not going to give you 100. We're going to give you 50 based upon what you sent in.
And now instead of getting 18%, they're getting 40%.
Exactly. So that was the ERTC mill. So now the IRS has come along. They've kind of reopened the program. And what they did for a little bit was they said, hey, we won't accept anything from a third-party provider or a paid company.
That would be the mills.
The mills. So if you as a business owner were able to put your paperwork together and send it in, they would actually accept it. The trick is you would have to go to a third-party provider, have them build it for you. The CPA there signs off. They send it to you. You sign off as the master, and then you mail it in direct. And then that way you got their attention in a sense. They'd work on it. But what they're saying today is they are actually, within the next week or two, sending out 20,000 rejection letters saying you don't qualify, this paperwork shouldn't be here. And the bulk of those are coming from these mills, where you call an 800 number and they say, give me this and this and this information. And, oh, yeah, you're good. We'll get you $100,000.
So just really quickly, how do you qualify? Who doesn't qualify? I mean, you have to be a real company.
You got to be a real company, and that's one of the issues. A lot of people made up companies, just like they did for the PPP loans.
Yeah. Oh, my gosh.
And they were buying Rolexes and Ferraris. And
I love to see the stories of these guys getting caught. But at the end of the day,
it's our money.
Yeah.
I mean,
they got the money to begin with.
Yeah. The feds gave them.
Try to claw that money back is
they won't get it.
Impossible.
So there's a Ferrari floating around somewhere in a Rolex. So what? I mean, it went down in value, depreciated. It's not worth the same dollars.
You think some
guy
at the IRS is driving that Ferrari?
Yeah, he's probably got 2 Rolexes on, and he's got a Ferrari. He shows up in the parking lot every day. Hey, this is mine.
Yeah. We clawed this back.
Yeah. But so the trick was you had to have 5 employees. You had to have, hypothetically, and there's a lot of factors in this, a 25%.
5 full-time employees.
5 full-time employees. Yeah. You had to have a 25% reduction in revenue, so you had to justify your loss, where then the employer stepped up and kept people rolling. Mm-hmm. There's industries that are exempt where you can't do it. Accountants and financial planners being a couple of them. Mm-hmm. So that's just the baseline. And then there's a lot of IRS programs, so there's a lot of weird factors that could work for you or against you.
If you were a small business and you had 5 full-time employees during the pandemic and you had a 20% loss in revenue, That's your jumping off point.
Yeah, that's pretty much starting point. And then there's factors that help you or play against you as you go forward. And that's why you hire a reputable third-party company,
Jeff Zufall,
to build the stuff for you to say, hey, you make the cut. And, you make it under an exception or you make it just straight across at face value.
So if you were a small business and you kept employees on during the pandemic and you think you meet the requirements and you were seeing the commercials with the guy from Modern Family and you say, oh, yeah, I've heard about this on Jeff Zufall's show on the weekends. Let me call that guy up and see what he can do for me. Call Jeff Zufall up. He specializes in small business. He does this stuff for a living, not just, these ERTC mills are like, to me, like the roofers that come in at the storm chasers.
Storms, yeah. And that is an issue because then when you submit your claim, you get paid, and then the IRS comes back 6 months, 8 months later and says, oh, no, but it's an illegal claim. That mill's gone. Nobody's going to help you. You're on your own trying to figure that out. With
just a boo-doo-doo. We're sorry. This number doesn't exist anymore. Give Jeff a call, 636-394-5524. Small business, think you qualify for an ERTC reimbursement? Go straight to the source.
Exactly.
Capital Advisory Group.
See if it's legit. And there's still time. I mean, a lot of people are like, hey, they have not shut the door yet. But what takes place in, I believe, don't quote me on this, but I believe in March of 2024, you start to lose the first quarter of 2020. And then it goes each month as you go forward in 2024, it goes less and less and less. They phase it out, basically. Yeah.
Eventually.
And nobody knows what the, I say, bottomless pit is as to, is it a $500 million project? Is it a $500 billion? Nobody knows.
Really?
So, yeah. It's just more so time is what they're saying. The time clock's ticking. So if you've been thinking about this, borderline, call us. We'll help you see if you qualify.
Yep. And then Purdue Pharma was in the news. They claimed bankruptcy. This is the OxyContin pill producers.
This is interesting.
I mean, we watched Dope Sick with Michael Keaton.
Yeah.
I mean, it's just criminal. It's
exactly.
Criminal what these people did, not just to get people hooked on OxyContin, but to, fake the numbers, to massage the FDA.
To keep the profits rolling in the door.
To keep it rolling in. How do we get people hooked, more and more, keep them coming back for more? Criminal what they did, but, these people never see the inside of a jail cell.
Yeah.
But.
So Supreme Court's now looking at this, and what they're saying is the family for Purdue has claimed bankruptcy, but they're allowed to keep a rather large chunk of money for the family. Not in stock because the stock of that company is worthless, but they're allowed to keep this cash basically. And it's not like they got $1,000. I mean, it's a couple $1 billion.
Billion. So the settlement is in the billions.
Yeah.
But at the end of the day, the way it's structured now, what I saw is within 5 years, the billions that they were allowed to keep will offset what they had to pay out.
Exactly.
And it's just,
why
is this a punishment?
Exactly. And they're kind of hiding behind the bankruptcy laws, if you want to call it that. So the question is, the Supreme Court is actually looking at this and not looking at that case individually, but if you own a business and you claim bankruptcy, I mean, we may be stumbling off in the legal category, and I'm not an attorney.
Sure.
But that's the bankruptcy protection helps you if you have a corporation. They basically get what's in the corporation. They can't come after your personal assets. Mm-hmm. But now the Supreme Court's looking at this case. So the question is let's say they rule against the family and say, hey, you can't have that money. How many other cases is that going to open for everyday people? Not that, you had a business, it went bad, you claimed bankruptcy so you didn't have to, pay $1 gazillion. Is that going to open up the door for these other, bankruptcy provisions?
Are we talking the difference between company assets? Like we've got an LLC. Yeah. Just in case we get sued.
Exactly.
They take the condo in Gulf Shores, but not my house.
Exactly. They don't take
St.
your
Charles.
Personal assets. They don't come seize vehicles, all that fun stuff. That's the beauty of having it's a limited liability corporation. It's limited to that corporation. Unless they could prove, and here's the weird one, that you really hurt somebody, and that could be the game that they're using for Purdue, which is they did.
Oh, my gosh.
Kill people.
Yeah.
But at the end of the day, that's your protection in a sense. So you put your corporate assets in a S corp, C corp, LLC, and you're protecting you're protecting your personal assets as a game. So it's kind of interesting how this goes down. I'm very curious how they rule this. Again, I'm not an attorney, but it still makes you go, ooh, bankruptcy is for a business owner is always that. I don't want to say out, but it is. So if something goes terribly wrong, you claim bankruptcy, reset the deck, and go forward from there.
But it's one of those things where, what is bankruptcy? And that's in the legal world, and that's a different show for a different day. But I was watching this documentary. It's called Rich Kids, and Ivanka Trump, Trump's daughter, was on it. This is years ago when she was just in her 20s, and they just interviewed, the Johnson & Johnson heir was the director, and he interviewed all of his rich friends to kind of point out how the world is different for rich kids than for the rest of us.
Yeah, completely.
But Ivanka said that they were leaving Trump Tower one day, and her dad, President Donald Trump, not the president at the time, was he's had multiple bankruptcies.
Oh, yeah.
He pointed to a homeless person begging for money on the street, and he told her, that guy right there is worth more than we are right now. Yet they had,
walking, exactly. Probably
I would
had
say
a driver.
Ivory Tower, but it's a golden tower.
Oh, yeah, it's definitely a golden tower.
You ever see the inside of that apartment? And, they had a great place to sleep, and they were eating fantastically. So somehow, somewhere, the bankruptcy rules are, they're
goofy.
A mystery.
Yeah,
to
kind
me,
of goofy.
It's like if you owe money, shouldn't you take everything?
Exactly. But they don't. That's the protection. You put that wall up there and say, hey, my personal assets are now totally different
from my corporate assets.
And the corporation does maybe go down to 2, maybe reorganizes, whatever. But it's very interesting. The Supreme Court's now taking this on. And you have people going, yeah, the family shouldn't keep that money. But then you have other people sitting going, hey, just the precedent that sets out there to go, could that open 100 million cases to go back to and say personal assets should come over?
Those protections actually protect the bulk of us, not just the billionaires.
Yeah,
like I said, with me, I need to be protected.
Yeah. Somebody comes to sue you for $100 million. It's an LLC. You go, hey, have the condo, thank you, and there's $10 in a bank account. See you.
Yeah,
I
still have my house.
Yeah,
but it just seems weird that the Purdue people are saying, "Woe is us, we're bankrupt."
Yeah, well, because they had $100 billion, now they got 5 or 7, I think.
And they're still sitting on $5 billion.
And that's a lot of zeros.
Yeah, so we'll see how that plays out, and then. Just really quickly before we go to commercial break, the IRS is charging 8% interest on estimated underpayments.
Yes.
Where in the past they only charged...
It's like 1.5%, 2% max. So again, not to say, hey, don't pay your taxes, by no means. But in the past, the game was, could you go put your money someplace, make better money, and then pay the tax and pay the interest when you do your tax return. So what this is anybody that is self-employed, gig worker,
people that have to pay estimated payments once a quarter, 4 times a year.
Yes.
Because if you aren't working for a company, if you're working for yourself, you're self-employed, the government doesn't want to hit you with a big – because you're not getting necessarily money taken out of your paychecks.
Never. And if you're a gig worker, you get a 1099, 1099K. Whatever the case may be, you're not paying taxes.
I made $100 and there's $100 on my paycheck.
Exactly.
There's the taxes.
You should have $20 that's allocated, 15% federal, 5% state. But also what's in there is that Social Security and Medicare, okay? So that's to a self-employed person, that's called self-employment tax, okay? So if you're self-employed and you're an Uber driver and you make $5,000 extra, at the end of the day, if you're profitable, if you don't have $5,000 worth of deductions, you're going to pay 15%, 15.3 to be exact, in self-employment tax, which is 6.2% to Social Security, 1.45 to Medicare, and then you, as the owner of the company, match that dollar for dollar. So it's 15.3 at the end of the day. Yeah. So what they're saying is these people are not paying these taxes, and this is kind of out of the blue. I shouldn't say that. Kind of developed quickly where they're now zipping people left and right for not making estimated. And what they mean is if you made 2 estimated payments, that's great, but you're still too short, and we're going to hit you for this 8% penalty.
And the way I understand it is, again, me personally, if I was self-employed or I was, working freelance, I'd get my paycheck, I'd put it in the bank, and I wouldn't think anything
Go to
of
town
it.
till you do your tax return, and then
Come
you go,
tax
whoa.
return time, and they say, well, you owe us this, you owe us that.
Yes.
And I didn't plan for that, and I forgot about all that.
Yes.
They're like, okay, rather than do this once a year and catch people off guard because now we got to chase them down and put them on payment plans.
Yes.
Let's do it once a quarter. So maybe they keep remembering, oh, that's right, I have to pay tax. Oh, that's right, I have to pay tax. Oh, that's right. Because at the end of the year, boy, that's coming out of the blue. I didn't save money for this.
Exactly.
Well, that's because the government says, well, that's your fault.
Exactly. And
not ours. Give us our money.
Yeah, we want the tax. And, by the way, we're going to hit you for this underpayment penalty, so you're going to pay even more tax.
But it used to be 1 to 1.5%.
Like 2% max.
And you were telling me some people would say, you know what? And rather than pay my estimated payments, I'll take the 1% knock, but I can put that money for the rest of the year in a 5 to 6% return.
And you're ahead of the game.
And then you're ahead of the game. And here, government, here's my 1.5%.
Yeah, here's but today
you still ended up making 3 to 4%.
Yeah.
Now the penalty is 8%.
Yep.
So
and you won't beat that in the open market unless you're very skilled at what you do, and it's not worth it anymore to take that risk.
I'll just tell you right now, you're not that skilled.
Yeah.
8% return, you find it and you let me know.
Yeah.
So that is out there right now. So if you're an estimated payment person, self-employed, gig worker, this pertains to you.
This definitely pertains to you. So there's actually public service notices that are put out there, but I don't think many people pay attention to them. And that's the IRS saying, hey, we raised the rates. You might want to worry about this. Yeah, right. So, again, the estimated payment concept, if you're in this category, call us. We can help you get on track, is for equal payments. So most people go, well, hey, I made 2 of them, so it should be half that. No, it's not. What they look at it is you have a due date, which is basically April 15th, June 15th, September 15th, and January 15th. And so if you owe $1,000 tax, it should be $250, $250, $250, $250. If you're late, then this is when these penalties are imposed. Yeah. So if you don't make the payment till the 20th, you're 5 days late. So most people bring us their tax stuff, and we say, hey, do you make estimated payments? And they're like, hey, you should know that. You told me to make them. I'm like, I told you to make them, but I don't know if you made them.
Made them.
So,
and that's the thing. Yeah. You specialize in small business. You specialize in, self-employed.
Yes.
And all that stuff. So if you have any questions about this, which you have to, I can't imagine. You got a construction company, or I always use the flower shop.
Yeah.
You're good at flowers and you're good at construction.
Exactly.
You're probably really bad at taxes.
And QuickBooks sells this is the plug for the accounting side. QuickBooks sells, QuickBooks Online. It's simple. You just, buy it and just plug your numbers in. You still have to have an accounting background to be able to make it work correctly.
Right.
Seriously. You got to understand debit, credit, all that fun stuff. And how to categorize stuff. That's usually what we see at the end of the year is, and people, no harm. It's just it. They bring us in their QuickBooks. They're like, I'm good to go. And then we look at it and we're like, you can't just pile it all up in, I don't know what this expense is and just plug a number in. It has to be broken out in categories where it's spent. So we help people with that. Get their QuickBooks back on track, if you want to call it that. Some people we look over their shoulder quarterly just to make sure QuickBooks is okay. Some people we look at it annually, year-end stuff, just to look at it and go, hey, you're good, or we make a couple of adjustments in there.
Yeah,
but
I want you to look at it daily because I don't know what I'm doing. I still don't even know the difference between gross and net, and there's
there's a huge difference
there. So that's why my wife handles all
exactly,
that stuff.
Exactly.
As someone who sees this every year on a daily basis, anecdotally, how many people would you say are in the category of self-employed, gig economy, making estimated payments?
Remember, this has grown exponentially from 2020 to today. Again, back in the day, and I say in the day, the IRS has put reports out there to say there's been more tax ID numbers created in 2020 and 21 than historically ever. So what that says is a lot of people are creating their own thing.
They're doing their own side gigs.
Side gigs.
This might not even be their main job.
No, it could be. We got people that make $2,000-$3,000 a year on a side gig. But that counts. It counts. It's part of. So this is two-pronged. Probably 20%, 25% of our practice has estimated payments that should be due. Some people don't pay them. Some people are adamantly not going to pay them. But I think when they see this 8%, they're going to go, "Ooh, let's pay them."
Yeah, the 1% is easy to swallow.
And
8,
then
impossible.
It's a chunk. And then the flip of this is here's another. There's a public service comment out there. If you own a business, and when I say that, most people think, "Oh, a big corporation." This is if you got a side gig going. You got a side gig going that made no money, but you have an LLC, what's called a sole proprietor. An S Corp, a C Corp, a partnership. What's going to take place 2024 is you have to report who the rightful owners are of these corporations by December 31st of 2024. And this is not the IRS watching.
This is next year.
This is next year. And it's coming. So, we're in December. It's right around the corner when we have to start worrying about this. And most people are like, "Oh, I'm not going to worry about it." I would be very worried because you're reporting to FinCEN, which is Financial Crimes Network. So you have to you just can't fill the app out and go, "Hey, my name is Jeff and I own an accounting practice," and that's it. You actually have to take who the rightful owners are, and you have to prove you got a copy of a driver's license, a passport, and you have to lay all that out and turn it in.
And this is to prevent people from making shell companies?
Yeah, basically what it
companies.
is. This came out in the Inflation Reduction Act, was tucked in there, and nobody knew it existed. And then, poof, it shows up.
If you're a real company, you have to prove that you're actually making money.
Not so much making
doing
money.
Business.
They want to know who the rightful owners are of these companies. And what they're thinking is everybody that's normal is going to report. The problem is, and there's the National Society of Accountants, and I think the CPA Society has petitioned them saying, "Hey, this is a little extreme." They're saying if you do not file this, so let's say you file your original paperwork in March, and everything is great, and then you decide to move in June. You actually have 30 days from the date that you moved to report your address change. Otherwise, it's $500 a day penalty going forward. And I'll repeat that. It's $500 a day penalty going forward.
A day.
A day. And then it's Big Brother watching, huge. But what it is we had people 2 years ago. I had somebody come in and they had 5 LLCs. That I looked at that and I was like, "What?" And literally the concept was, we got all the LLCs out there. It makes it hard for the IRS to track us. And I'm like, no.
Right.
Makes you go to the top of the heap because they're going to come after you.
Right.
So people think that they create all these LLCs and create these shell companies and move money back and forth in the IRS and never find it. They will find it.
Let me just say this one more time. You don't have to create 5 LLCs and move money around and this to hide from the IRS. You can probably find just as much in tax savings by doing it the legal way.
And not play that game.
And not face jail time or huge penalties by just calling Jeff and doing it the legal way. 636-394-5524, CapitalAdvisoryGrp.com, Capital Advisory Group, Jeff Zufall, 636-394-5524. And I wonder how much these people hid or shelved away from the IRS that they could come back at any time
and say,
find it.
"Hey, we found it. You owe us a ton of money."
You're always going to be looking over your shoulder.
Yeah.
You could have gone to Jeff and not only kept that much money, but he probably could have found you something even more.
Exactly.
So just do it the legal way because there are things built into the tax code, believe it or not, that pertains to the little guy and small businesses and the you and me's of the world. So stop trying to hide your money from the government because they know where it is.
Yeah.
They know where it is.
They'll find it. Might take them 2-3 years, but they'll catch it.
They'll find it.
Yes.
Do it the legal way. Have somebody like Jeff in your corner who's a wealth advisor and a tax advisor, and maybe he can find you even more than what you were trying to hide. Yes. So 636-394-5524. Last thing I'll say on it. We'll go to commercial break. We'll come back, and with the little time we have, maybe we'll get into year-end planning. Here's the good thing. We've still got a week or 2 or 3.
3
weeks.
3 to get,
that we can still do this topic. So you do have time, and we'll hit the main points of things to look at in your own finances and say, maybe I can do this before the calendar changes over and I'll call Jeff and get an appointment to get this done. 636-394-5524. It's called Keep What's Yours on the Big 550 KTRS.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, and I realize as I'm looking at the clock that we really spent way too much time doing other stuff, that we didn't even get to our topic of the day. It's a common theme of all the shows that I do. We get sidetracked.
Maybe we talk too much.
We give really good information. Let's do something really quickly, year-end stuff. We're going to spend the next 2 or 3 weeks talking about this anyway, so keep tuning in. It's time for you to sit down and look at your stuff. Jeff, what's the first thing that we want to look at as we do our year-end planning?
First thing is go look at your most current paycheck stub. Look at the earnings, year-to-date earnings, and look at what the federal and state tax withholdings are and compare it to last year. All you're doing is to see are you on target? Did you have equal to last year withheld? Did you have less withheld? We see a lot of people where through the year their paycheck gets goofed up, and they don't have a state withholding. They don't have a federal withholding, and it's an issue.
And is there something that can happen where our withholdings, without us making any changes?
We've seen a couple dozen of them where their state withholding went to $50 a year, and it was like, what? Yeah. So they owe a couple $1,000 to the state of Missouri or state of Illinois.
You plead your case. Well, I didn't know this happened.
You can try, but they don't care. They're like, hey, you owe us.
And unless we're looking at our paycheck every,
never
down
notice
the line, every 2 weeks.
Never notice it. Yeah. Seriously. So again, that's probably the biggest one out of the box is
check your withholdings.
Check your withholdings.
And compare them to last year.
Compare it to last year and see if you're in that same range. You're okay. That you've paid in enough that you shouldn't hypothetically have a huge withholding issue. But if you see where you had $10,000 in federal tax last year and you got $8,000 this year and your income is the same, there could be an issue. Mm-hmm. And again, it could be that you can put more in your 401k, but that's the stuff you can work out later.
And we've done this earlier in the show talking about Roth conversions, but I want to talk about maxing out just really quickly. Mm-hmm. You can do the math now.
Yes.
And you can see where you are and where you're going to be in the next 3 weeks. Nothing's going to happen major in the next 3 weeks.
By taking that paycheck stub, you know where your gross income is. And then you say, hey, plug it into the little charts on the tax brackets and say, if I did another $20,000 in a Roth conversion, I would step over that number. Mm-hmm. So I say it's an easy calculation, but
you're walking that tax bracket tightrope.
Exactly. But if that's a question you have, call us. We can help you.
Yep, 636-394-5524. And now's the time where you max out your 401k. Now's the time where you do your Roth conversion because you know what the numbers are going to look like. Nothing's really going to change in the next 3 weeks. You're basically already there, and you can do the math and say, hey, I can convert another $15,000
exactly
in this tax bracket without hitting that threshold.
That next threshold, exactly.
And getting nailed.
Yeah.
So now's the time to actually do this stuff, and now's the time to call Jeff. 636-394-5524. Jeff, over the next couple of weeks, we will do deep dives, year-end stuff, because it is the end of the year. Happy holidays, everybody. Happy New Year coming up. But now's the time to really make some moves to make sure that you can walk that tax bracket tightrope.
That's right. Yes.
And make sure you don't fall into the
abyss.
The abyss of taxes and overpaying your taxes. We want you to keep what's yours. That's the name of the show. That's the name of the book. And that's the name of the lifestyle that Jeff leads. We want to keep your money in your pocket rather than going to the federal government in the form of taxes. Jeff, thank you so much.
Thank you.
We'll talk to you next week.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5524 or visit CapitalAdvisoryGrp.com.